Hello Maverick traders, this is Imre and welcome to today's class on trading the zigzag pattern. This is where the rubber meets the road. We've covered these corrective patterns in the previous classes and we're now moving on to what I call monetizing your market analysis. So remember, I look at market analysis and forecasting as a separate discipline, a separate skill set from actually trading. So we've gone over market analysis over the last several weeks in my recurring series of videos on corrective patterns and the wave principle, and we're now moving on to how do we actually trade some of these patterns. So today we'll be looking at a core corrective pattern known as the zigzag. So trading the zigzag. I'll be covering entry and stop loss techniques. I'm not going to be going over targeting in these videos. I'm going to have a separate video for how I come up with potential targets on all my trade setups, as well as how I implement a trailing stop loss myself. I love using trailing stop losses instead of hard limit orders in terms of taking profits for the most part, because that's what allows you to be pleasantly surprised when a regular old trade starts to run and run and run and turns into an absolute screamer of a winner. All right, so there are many potential entry techniques when it comes to the zigzag. You have a choice to stick to only one method, or you can incorporate several into your overall toolbox. Which path you take will always depend on your unique strengths and weaknesses as a trader, and of course, your own personal risk tolerance. I personally use a variety of techniques to trade the zigzag, so all the techniques I'm going to be teaching you today are techniques I actively use myself. Which specific technique I use depends on each individual zigzag in front of me at the time. And the variables I take into consideration when I'm trying to decide which entry technique I'm going to use involves balancing a number of factors, including probability that I've actually timed the market correctly and that the pattern I'm tracking is complete, as well as the profit factor of the potential trade that I'm considering. So stop loss placement is very straightforward. You have two options. The first is to place your stop just beyond the extreme of wave C of the zigzag, which we're going to take a look at examples. So don't worry if this is sounding a little bit confusing without a visual aid. I'll have the visual aid for you very soon. Now this method will maximize the risk reward profile on the potential trade. The second option is to place your stop just beyond the extreme of the impulse wave immediately preceding the zigzag. This method definitely gives you more wiggle room in the event that the zigzag is not yet complete after you've entered into a trade. So like I said before, which path you take in terms of stop loss placement will depend on your individual strengths and weaknesses, as well as your personal risk tolerance. All right, so entry technique number one, candlestick patterns. Candlestick patterns can be incredibly effective to enter into a trade, regardless of the pattern. Now, the typical behavior that I'm looking for, which involves leading to a change of character as a corrective pattern comes to an end, is a visible decrease in momentum. So I'm looking for small body candlesticks with wicks on either side, doji candlesticks, that kind of thing, followed by a strong candlestick in the direction of the larger underlying trend. So what exactly is a strong candlestick? Well, some examples would include candles with a long lower wick, that would be in a bullish trend, or a long upper wick, that would be in a bearish trend, followed by a close near the highs or lows of the candle. The final thing I look for when I'm dealing with bullish candles, that is for the candle to make a higher high and a higher close relative to the candle immediately preceding it. A bearish trend would mean looking for a candle with a lower low and a lower close relative to the candle immediately preceding it. So we're going to take a look at that right now. So here we are on the euro. We've got two zigzags. I'm going to be focusing on the first one right now. So we're going to draw a little bit here, and I want to point out where I see that decrease in momentum. It's right here. Notice how the candlesticks start getting smaller in size over here. And then we get this doji candlestick right at the bottom. You can compare that to these larger bodied candlesticks, that start forming on the price chart as the corrective pattern unfolds. And then we get this nice bullish engulfing candlestick. Notice how it both makes a higher high and a higher close relative to the candle immediately preceding it. So this could be your trigger candle, your entry candle. You could enter the market on a close of this candle right here. The second zigzag, notice we have this one really big, scary looking bearish candle right there, and then the rest of the candles in the series start having long lower wicks, showing buying pressure is visibly entering into the market. We then get this bullish doji candle followed by this strong candle right here. Sorry, this one right here to be more specific. Notice how it closes near its highs, and both the high and the close of the candle is higher relative to the candle immediately preceding it. Now, in both situations, you definitely could have gotten away with placing your stop loss just beyond the extreme of wave C. If you wanted to take a more conservative stop loss option, then for example, your stop loss, if we're trading this zigzag right here, you could place your stop loss right here, which would be just below the impulse wave immediately preceding the zigzag. I'll show you a little bit later on some hypothetical trade examples where you'll see, what the impact of such a stop loss placement can have on the overall profit factor of the trade. Okay, so we're now moving into another zigzag. This one's an engine coin, cryptocurrency. So again, you can see we've got these large, we have these large bullish candlesticks here as the zigzag unfolds. This one in particular, right? This is convincing everyone that the market's going to be bullish. And then we get a visible decrease in momentum. Notice the smaller bodies in the candlestick. Notice we're starting to see a mix of bullish and bearish candlesticks. We get a little doji candlestick, and then we get this larger, scarier looking bearish candlestick. So in this case, we could enter the market on a close of this candlestick with a stop loss just above the wave C extreme, giving you an incredibly favorable risk-reward skew. So moving on to entry technique number 2, which is the break of the extreme of wave 4 of wave C. This is my favorite overall entry technique because it balances a high probability of successfully timing the market with what is typically an excellent risk-reward profile as well. This technique only works if you can count a clean 5 waves for wave C of the zigzag. If you have any doubts about the internal structure for wave C, do not utilize this technique. Sometimes it is necessary to drop timeframes to zoom in to the overall structure of the zigzag in order to see the subwaves more clearly. So here you can see in this example, again on Engine Coin, this time I'm labeling the internal structure of this wave C. So you can see I've got little 1, 2, 3, 4, and 5. And what I like about this method is that it gives us a rock solid level, right? Like an objective price level. There is a degree of subjectivity with candlestick analysis, which is, it's impossible to escape from that. Counting waves, however, gives us very precise entry levels. This also gives me the added benefit of being able to set a pending order, such as a sell stop, and walk away from my platform. So in this case, the sell stop comes in at just around, let's say, 117 in Engine. So I can place a sell stop a little bit below 117, maybe around 116, 115, even 114 to account for a bit of the spread, walk away, and then I can place my stop loss just beyond the extreme of wave C, and the trade will unfold nicely. Here's another example, again in the euro, and again I'm labeling the subwaves for wave C of the zigzag. And you can see that wave 4, the wave 4 extreme comes in at 104.85. So we're entering the market long on a break of that key level, and we can again just place our stop loss a few ticks beyond the extreme of wave C. And another example here, once again in the euro, you can see here we have a 5-wave decline for wave C, and the wave 4 extreme comes in at 105.54. So we place a buy stop a few pips above there, and that's how this entry technique works. So moving on to the final entry technique, which is break of the wave B extreme. This is the most conservative entry technique I recommend that is specific to the zigzag pattern. Now this technique should be used if there isn't really a suitable candlestick pattern or the subwaves of wave C are not very clear, which happens from time to time. The textbook is great. If real markets always followed the textbook, this would be easy and everyone could do it. So I love the fact that this is very difficult to do because it means that there's now an opportunity for people that are able to do this to excel. Anyway, so this entry strategy offers us a high probability of timing the end of the correction, but you may sacrifice some of the risk-reward profile on the trade depending on the location of the wave B extreme. So we're going to take a look at that in just a moment as well. So check this out. Here we have a zigzag in the Australian dollar Japanese yen currency pair. And you'll notice here, I can't really identify a suitable wave 4 extreme. Like it's not readily obvious to me where it is. If I had to guess, it would be somewhere around here. And while this is a bearish bar, notice I'm using a bar chart here, not candlesticks, because I want to show you don't actually need candlesticks. I don't like using a candlestick chart because, I will sometimes, but I like bar charts for counting waves because it makes it a little bit easier to track the patterns. Anyway, while this bar is bearish, it's not very large, especially relative to the bar that immediately precedes it. So in this case, I can't identify a suitable candlestick pattern. I can't really identify the wave 4 extreme. So here I'm going to go with the easy to spot wave B extreme, which comes in at 91.49. So we place a sell stop maybe around here, just a few pips below that wave B extreme, place a stop loss a few pips above the wave C extreme, and there you go. Now you can see that we're not getting that kind of tight entry that we saw in the previous examples, which means you are going to give up a little bit of the potential reward or the potential upside on this trade. Now here's an example on the British pound US dollar currency pair on cable. So again, I don't think the wave 4 extreme is readily obvious here, and there isn't a good bar or candlestick pattern. So again, I'm going to go with the wave B, a break of the wave B extreme, which comes in at 124.36. And you can see this is a very good entry method. The market does tend to break higher if you've correctly identified the zigzag pattern in the first place. Now we're going to move on to some hypothetical trade examples on various markets, various price charts. I don't want to get caught up in how I'm setting these targets. The reason I'm setting these targets in these screenshots is more so that we can see the impact of the potential risk reward on these trades based on which entry and stop loss techniques we're using. So you can see here, whenever we're looking at entering the market off of a candlestick pattern, it tends to give us a very good risk reward ratio, right? Whether we're targeting short-term targets or intermediate or long-term targets, the risk reward is typically excellent. The downside to candlestick patterns is that it's a little bit more subjective, in my opinion. And if you don't see a good candlestick pattern on the 4-hour chart, but you see one on the 1 hour, is that valid? Is it, it gets a little bit messy sometimes. Sometimes it's very obvious. Like I believe here in this case, this candlestick right here, this big bearish one is very obvious. That's screaming almost that the market's going to head lower. Yeah, this one right here. So entering on a close, after that candlestick closes, I think makes a lot of sense in this particular circumstance. Okay, here we're using a wave 4 break technique. Okay, so here we've identified the wave 4 extreme of wave C, and you can see this also gives us a very good risk reward profile. That's why this is possibly my favorite method when a zigzag unfolds cleanly, because it allows me to easily identify that wave 4 extreme, and it typically gives me a very good risk reward ratio, so I kind of get the best of both worlds. Now this one is utilizing a break of the wave B extreme, that entry technique, and we're still placing our stop loss at the extreme of wave C. So you can see immediately the difference in the risk reward profile between this trade, and this one here. The risk reward potential is significantly less. Now here we have an interesting example where we're actually dealing with two zigzags. So here's my first impulse, here's my first zigzag, and then here's my first mini impulse and my first mini zigzag. And I'm actually focusing my trading on the mini zigzag. So you'll notice here I'm using the break of the wave B extreme, and I'm not placing my stop loss this time at the wave C extreme. I'm actually placing my stop loss at the extreme of the prior impulsive wave. Right? This gives me a bit more protection on the trade, and the upside was still fantastic, as you can see. So sometimes that method does make sense. And then finally, we have this example here in the Aussie dollar on the daily time frame. And here wave C took the shape of an ending diagonal. So for those of you who need a refresher on ending diagonals, please go ahead and pull up that video that I've recorded for you. You can find it either on the Maverick site or on our YouTube channel. So in this case, the wave 4 extreme of this ending diagonal was right here. We got away with a very tight stop, and the profit factor on this trade was fantastic. I'm showing you this example because obviously most trades don't unfold like this, but some of them do, and that's the really cool thing about this. When I first take a trade off of a zigzag, I don't know if it's going to be something like this, or if it's going to be something that's a lot, or if it's going to be something that's a lot more modest, like this trade here, which looks a little bit closer to 1-to-1, potentially less than 1-to-1. If we got stopped out on the spike here, maybe we would have gotten out realistically at break even. That happens too. The point is, I don't have an expectation of the market. I'll pick the entry technique based again on weighing potential profit factor and how confident I am that the zigzag is actually completed. And then, I'll size my position, and then I'll implement my risk management strategy, which again is going to be covered in a separate series of videos. So I hope this was helpful. I hope you learned something about the zigzag and how to trade them. Everything I'm teaching you is coming straight from my own personal trading plan. It works. I'm telling you, it works. So, it works for me, and I hope that you find a way to make it work for you as well. If you have any questions at all, please feel free to get in touch. I'm here to help. Thanks, guys. See you in the next one.